Well, thank you, Mr. Chairman, and thank you, Madam Chair, for your leadership. Some of my colleagues in the Congress have called on the Federal Reserve to use a formula, a very strict formula in setting interest rates. Many times they refer to the Taylor rule. Could you explain to us how this would affect particularly working Americans? How do we, would it be good or bad, and how do we explain its ramifications to our constituents?
Well, right now, the Taylor rule would call for a short-term interest rate somewhere between 3.5% and 4%, which is obviously a much higher value of the federal funds rate than the FOMC has deemed appropriate given the needs of the economy. I believe we would have a much weaker economy if in the last number of years we had followed the dictates of that rule. Unemployment would be substantially higher, the labor market would be weaker, and instead of inflation, which is running below 2%, and we want to see it move up to our 2% objective, I believe inflation would likely be lower than it is now.
So we'd see fewer jobs, higher mortgage interest rates, a weaker economy if we were essentially just automatically following a formula.
That's right. I recently, a few weeks ago, gave a speech at Stanford where I tried to explain why I thought it was appropriate to adjust the recommendations of rules like that to take into account, for example, the fact that not only the FOMC, but most outside forecasters believe that the so-called neutral rate of interest has been unusually low in the aftermath of the crisis. And the Taylor rule would assume that it's at 2%. Current estimates would put that estimate closer to 0.
Thank you. There's another aspect I've been working on for years, and particularly incorporating some of the language in the Dodd-Frank bill, is ensuring that clearing platforms are used, but there is a risk because systemic failure would be significant. So can you give us an update on what you are doing, your colleagues, to ensure that these central clearing platforms are adequately protected from a failure, i.e. the consumer is ultimately protected from failure?
Well, we strongly believe that well-regulated and well-managed financial market infrastructures, and that would include central counterparties, play a positive financial stability role. They can help stem the propagation of disturbances, and they reduce the volume of transactions among key financial institutions. And we think they play a financial stability role, but they can also be sources of risk to the financial system if they're not themselves well managed. Title 8 of Dodd-Frank created a structure in which the Federal Reserve, the CFTC, and the SEC have oversight responsibilities to make sure that these key infrastructures of our financial system are managing their own risks successfully. And we're cooperating with the other regulators in our examinations to make sure that appropriate risk management standards are in place.
Thank you. Final question in that. Cyber security is the issue on everyone's mind, and you recently have an advance notice proposed rulemaking which would require board of directors to have adequate expertise. I've been involved with legislation that would apply not just to financial institutions, but a publicly held company, because the cyber threat is not limited, it is ubiquitous. Could you just briefly, and very briefly, give us your sense of how important it is to get this cybersecurity expertise on boards?
Well, I think cybersecurity is a major, major risk that financial firms face. I think they're very well aware of the risks, and my sense is that boards of directors generally appreciate the seriousness of cyber threats. but sometimes they don't have a comprehensive or enterprise-wide view of the institution's capabilities in this area. And so it is very important for boards to have appropriate expertise.
Thank you very much, Madam Chair. Thank you.